Messy does not equal fraudulent. Messy equals human. Unaddressed messy equals risk. Addressed messy equals maintenance. And maintenance is part of business ownership. The goal of this episode is not to make you feel careless. It's to move you from panic to process. Let's be honest. At some point this year, you reached into your wallet and pulled out the wrong card. You were at Target or Costco or the gas station or the airport grabbing a quick coffee before boarding, and without thinking, you swiped. Then, about 10 seconds later, maybe when the receipt printed, your brain went, oh no. Maybe you paid for a client lunch with your personal debit card. Or maybe, and this is the one that causes the most 2 a.m. spirals, you used your business credit card for a Target run that was 90% throw pillows, snacks, and one lonely pack of printer paper. And suddenly you're questioning your entire legitimacy as a business owner. Welcome to co-mingling. In accounting language, co-mingling simply means mixing personal and business funds. But online, it's treated like the original sin of entrepreneurship. You'll hear things like, you just pierced the corporate veil. The IRS will collapse your LLC. You can lose your liability protection. If you co-mingle once your whole entity is compromised. Deep breath. We are going to bring this back to reality. First, yes, separation matters. Second, no, you did not destroy your business because you bought groceries on your Amex business card. The internet tends to swing to extremes. One side says commingling is catastrophic. The other side says it doesn't matter at all. Both of those positions are wrong. Here at Zero Fluff Books, we live in the middle. And the middle says this: commingling is common. Commingling is fixable. Commingling becomes a problem only when it becomes a pattern of carelessness. Now let's separate two worlds. There is a legal entity law, which deals with courts and liability protection, and there is tax compliance, which deals with reporting income and deducting expenses. Today, we are talking about tax compliance, and from inside of the IRS system, from someone who reviewed hundreds of Schedule C returns, I can tell you this: the IRS is not scanning your bank statement looking for the Starbucks charge. The IRS cares about, did you report your income? Are the deductions you claim actually business related? Can you support them? That's it. They're not measuring moral purity. They're evaluating reporting clarity. And here's the part no one tells you. Almost every small business return has some level of commingling, especially in the first few years, because you are a human and you are also running a business. And sometimes those two roles share the same wallet. The goal is not perfection. The goal is consistency. If 98% of your transactions are clean and 2% require reclassification, that's bookkeeping. 50% are mixed and undocumented, that's when your financial story stops making sense. And when your financial story doesn't make sense, that's when scrutiny increases. Today, we are going to clean up the messy middle. We're going to cover why commingling feels catastrophic and why it usually isn't, what reasonable support actually means under Circular 230, how I, as an enrolled agent, am required to approach messy books, and most importantly, a step-by-step workflow to clean this up without losing your mind in QuickBooks, Xero, or Excel. If your bank feed currently feels like a judgment scroll of mistakes, this episode is your permission slip, not to ignore it, but to fix it calmly, because messy is normal. Unaddressed messy is risky. Addressed messy is just bookkeeping. Let's get into section 1. So why does commingling feel like such a crisis? Why does one wrong swipe of a debit card suddenly make you feel like your entire business structure is collapsing? For most business owners, it's because you've heard the phrase, piercing the corporate veil, and it sounds terrifying. It sounds like one mistake and a judge shows up, dissolves your LLC, and hands your house to a creditor. Let's bring this back to reality. Piercing the corporate veil is a legal concept, not a tax concept. It generally comes into play in litigation scenarios where a court examines whether a business owner treated the entity as truly separate from themselves. That analysis typically involves patterns of behavior, not isolated transactions. It's about whether you maintain separate bank accounts, signed contracts in the business name, kept basic records, and generally respected the existence of the entity. It's not about whether you accidentally bought groceries on your business credit card one Tuesday in March. Now today, we're focusing on tax compliance. And from a tax perspective, the IRS is not evaluating your liability shield. They are evaluating your reporting. Inside the IRS system, what matters most is clarity and intent. Did you report all your income? Did you claim deductions that are actually business related? Can you provide reasonable support if asked? That's the framework. When I worked in the small business self-employed division, I reviewed hundreds of Schedule C returns, and I can tell you something that might lower your blood pressure. Almost every single one had some level of commingling. It is extremely common, especially for sole proprietors and single member LLCs. Because when you are the owner and the operator, the human and the business share a lot of daily life. You grab a coffee on the way to the client meeting. You grab coffee on the way to a client meeting. You run to Costco for office supplies and personal items in the same cart. You book travel for a conference on a personal card because that's the one saved in your airline app. That is normal behavior. Separates a defensible What separates a defensible return from a risky one is not perfection. It's pattern and proportion. Let me explain that. If 98% of your transactions are clearly separated, business income into the business account, business expenses paid from the business card, personal spending from personal accounts, and 2% require reclassification, that's bookkeeping maintenance. That's not a red flag. That's adjusting entries. But if 40 or 50% of your transactions are mixed, uncategorized, and unsupported, that's when your financial story stops making sense. And that word matters. Story. Every tax return tells a financial story. Revenue comes in, expenses go out, net profit is calculated. If your bank account shows thousands of dollars leaving for grocery store, subscription services, and daycare, and those are all categorized as office supplies, the story breaks down. Not because you commingled, but because you mischaracterized. And that's an important distinction. Commingling is about where money moved. Categorization is about how you reported it. The IRS is far more concerned with miscategorization than occasional commingling. Let's take a simple example. You accidentally use your business card to buy $200 worth of groceries. If you properly categorize that transaction as owner or straw or personal distribution, you are acknowledging that the money left the business but was not a deductible expense. There is no tax distortion. The financial story remains intact. Now compare that to categorizing the same $200 as meals and entertainment. That changes your taxable income. That affects your tax liability. That's when you've crossed from simple commingling into incorrect reporting. And that's where problems begin. Another reason commingling feels like a crisis is because business ownership carries identity weight. You want to be taken seriously. You want to be legit. And separate accounts feel symbolic of legitimacy. So when you mix them, even accidentally, it feels like you've undermined that legitimacy. But legitimacy isn't built on flawless swiping behavior. It's built on consistent systems, separate accounts, regular review, timely correction. And here's something else I want you to hear clearly. The IRS understands that small businesses are run by humans. They know you are not a Fortune 500 accounting department. They know your systems evolve over time. What they look for is whether you are making a good faith effort to maintain separation and correct errors when they happen. Intent matters, pattern matters, proportion matters. If your books show that personal transactions are consistently reclassified to owner draws and not deducted, that shows awareness. If you reimburse yourself properly when using personal funds for business, that shows structure. If you reconcile monthly and catch errors early, that shows control. Those behaviors build credibility. Now let's address the emotional spiral. Some of you have opened your bank feed in January and thought, I've ruined everything. No, you haven't. You have transactions that need to be sorted. Sorting transactions is not a moral event. It's accounting. Messy does not equal fraudulent. Messy equals human. Unaddressed messy equals risk. Addressed messy equals maintenance. And maintenance is part of business ownership. The goal of this episode is not to make you feel careless. It's to move you from panic to process. Because once you understand that commingling is common and that the real issue is classification, the cleanup becomes procedural, and procedural problems are solvable. Next, we're going to talk about the professional standard that governs how this cleanup happens. Because under Circular 230, I can't just shrug at messy books and say, close enough. There is a standard, and that standard is called reasonable support. Let's move into that next. Now let's talk about standards, because this is where commingling stops being emotional and starts being procedural. As an enrolled agent, I am governed by Treasury Department Circular number 230. Circular 230 sets the rules for professionals who practice before the IRS. It outlines our obligations around due diligence, competence, and ethical behavior. And one of the most important concepts inside Circular 230 is due diligence, specifically under Section 10.22. Due diligence means I have to make a reasonable effort to ensure that what goes on your return is accurate. I cannot blindly accept numbers. I cannot ignore obvious inconsistencies. I cannot sign a return that I know contains unsupported deductions. That's the professional standard. Now, here's the good news. The standard is not perfection. The standard is reasonable support. There's a myth online that you need pristine museum quality bookkeeping. Every receipt scanned, every transaction color-coded, every expense cross-referenced with a digital filing cabinet, that's fluff. The IRS does not require aesthetic bookkeeping. It requires reasonable support. So what does that actually mean? It means that if you claim a deduction, you should be able to show that it was ordinary and necessary for your business. If you use a personal card to book a $700 flight for a business conference, reasonable support would be the flight confirmation email, the conference registration, a calendar entry showing attendance. That's reasonable. If you used your business card to pay for a personal grocery run, reasonable support means you did not deduct it. You reclassified it as an owner's draw. That's it. The standard is not never make a mistake. The standard is correct the mistake and don't distort taxable income. Now let's talk about what happens when books are messy. If you send me a bank statement and say, all of this was business and I see Disney Plus, local daycare, grocery stores, personal loan payments, I am required to ask questions. Not because I'm suspicious, because I have a professional obligation. Circular 230 does not allow me to knowingly ignore personal transactions being deducted as business expenses. If I see something that doesn't align, I must seek clarification. And that's not confrontation, that's compliance. Now here's where commingling becomes manageable. Cleaning up commingling is not about hiding personal spending. It's about reclassifying it correctly. If a $250 Target charge included $40 of printer ink and $210 of household items, the cleanup is simple. $40 goes to office supplies, $210 goes to owner straws. That shows the IRS the business paid for something personal, but it was not deducted. There is no tax distortion. The return remains accurate. That's reasonable support. Now let's introduce another section of Circular 230, Section 10.21, Knowledge of Omission. This rule says that if a practitioner knows a client has made an error or omission, the practitioner must advise them of it and explain the potential consequences. So if you tell me in April, I just guessed on all my mixed receipts because I didn't have time, I cannot ignore that. I have to explain that guessing is not reasonable support, but here's the balance. We do not need a forensic audit of every Costco trip. We need a consistent methodology. For example, if you regularly buy office supplies and personal items together, one practical solution is to split transactions at the time of purchase, or use separate cards at checkout, or review the statement monthly and split it in the software. Consistency builds credibility. Now I want to clarify something important. Reasonable support does not mean you need a receipt for every $6 coffee. But if you are deducting $12,000 meals, there should be documentation that supports business purpose. There's a proportionality principle at play. The larger the deduction, the stronger the documentation should be. That's common sense compliance. Now here's why this matters beyond just audit risk. When books are cleaned properly, when personal expenses are moved to owner's draws and business expenses are documented, your financial reports become accurate. And accurate reports are useful. They show real profit. They show real cash flow. They show real expense ratios. If you leave personal expenses in business categories, you distort your own data. You start making decisions based on incorrect numbers. That's not just a tax issue. That's a management issue. Circular 230's due diligence standard ultimately protects you because it forces clarity, it forces categorization discipline, it forces correction, and correction is what turns messy into manageable. So if you're listening and thinking, my books are a disaster, understand this. They are not a disaster if we can separate personal from business and support the business portion. They are a disaster only if we ignore the separation and deduct everything. Reasonable support. That's the standard. Not perfect separation, not panic, not shame. Reasonable documentation, reasonable classification, reasonable consistency. That's what makes a return defensible. Now let's get practical. Let's talk about how exactly to clean this up inside your software, step by step. Because knowing the standard is one thing, applying it is another. Let's move into the workflow next. All right, now that we've lowered the emotional temperature and established the standard, let's actually fix this. Because commingling is not a philosophical problem, it's a categorization problem. And categorization problems have workflows. We're going to walk through this in two major scenarios. Personal money used for business, business money used for personal. Let's start with the first one. Scenario A, you use personal money for a business expense. This is extremely common. You're on Amazon and the default card is your personal Visa. You book a flight on your phone and don't realize your personal debit card is saved. You grab supplies quickly and don't want to transfer money first. Now here's the mistake people make. They ignore it. They think, it was only $100, I'll just let it go. But ignoring legitimate business expenses distorts your numbers. It understates your expenses, it overstates your profit, and it increases your tax unnecessarily. So we fix it. There are two clean methods. Method 1, reimburse yourself. This is the cleanest option if your business has cash. You transfer $100 from your business account to your personal account. You label it clearly: printer reimbursement, flight reimbursement, office supplies reimbursement. In your bookkeeping software, you record the original purchase as a business expense. Then you record the transfer as reimbursement. The books now show the business incurred the expense. The business paid you back. Clear, clean, defensible. Method 2, owner's contribution. What if the business doesn't have the cash to reimburse you? You can record the expenses paid by owner's contribution. This tells the books, I, the human, put $100 of personal funds into the business. No cash leaves the business, but the expense is properly recorded. This keeps your P&L accurate, and accuracy matters more than whether reimbursement happens immediately. Now let's move to the second scenario. You used business money for a personal expense. This is the one that causes the spiral. You see Target, you see Costco, you see Starbucks, and you think, I've ruined everything. No, you haven't. You just need to categorize correctly. The key rule here is simple. Do not deduct it. That's it. If your business card paid for a personal expense, you categorize it as an owner's draw, owner's distribution, personal expense. Whatever label your software uses, this tells the system money left the business, but it was not a deductible expense. You are not reducing taxable income. You are taking profit. And the IRS does not care what you spend your profit on. They care that you don't call throw pillows office equipment. That's the distinction. Now let's talk about frequency. If this happens once a month and you reclassify it consistently, that's maintenance. If this happens daily and everything gets dumped into miscellaneous expense, that's when you lose clarity. Proportion matters. Now let's address mixed receipts, the half and half receipt. You go to Costco, you buy printer ink, paper, coffee pods, and groceries. Total $200. This is where people get overwhelmed. They think, I'll just round it. Do not round it. Most bookkeeping software allows transaction splitting. You click split, you allocate $50 to office supplies, $150 to owner's draw. Now your books reflect reality. Yes, it takes 2 minutes longer, but those 2 minutes protect your data integrity. Now let's talk about timing. Do not wait until year end to do this. The longer you wait, the harder it becomes to remember what was business and what wasn't. Memory degrades, context fades. That's how guessing starts. And guessing is where defensibility weakens. Instead, implement what I call the monthly scan. Once a month, take 15 to 20 minutes and review your bank feed. If you see something personal, move it to owner's draw immediately. If you see something business paid personally, flag it for reimbursement. Small monthly adjustments prevent massive annual cleanups. Now let's talk about documentation. If you are deducting something, keep basic support. Email confirmations, invoices, receipts for larger items. You do not need to save every $4 gas station receipt, but if you're deducting $5,000 supplies, you should have something to back it up. Proportionality matters. Now I want to emphasize something important. The goal is not to make your books look perfect. The goal is to make them make sense. A clean P&L tells a story. Revenue in, expenses out. Owner draws separate. When you consistently separate personal withdrawals from deductible expenses, you protect your tax position, and you protect your own decision-making clarity. Because messy books don't just affect taxes, they affect how you see your business performance. Now here's your zero fluff rule. Every transaction must answer one question. Did this reduce business profit for tax purposes? If yes, categorize as expense with support. If no, categorize as owner's draw or contribution. That's it. It's not moral, it's mechanical. Now we're going to talk about the messiest category of all, the truly mixed lifestyle, subscriptions, shared services, household overlap, because that's where the gray areas live. And gray areas require method, not panic. We'll move into that next. Next, we're stepping into what I call the messy middle. This isn't the obvious grocery run on your business card. This isn't the obvious printer reimbursement. This is the gray area, the Costco trip that's half office supplies, half household. The Amazon order that includes shipping supplies and dog treats. The subscription that's used for business and also personal. This is where people freeze because it's not clearly one thing or the other. And when it's not clearly one thing or the other, the temptation is to guess, or worse, to ignore it. Let's talk about the rule. The rule is not perfection. The rule is reasonable methodology. We are not doing forensic accounting on every household overlap. We are building a defensible system. Let's start with split transactions. Most bookkeeping software, QuickBooks Zero, even spreadsheets, allow you to split a single charge across categories. You should use this feature if your $200 Costco trip included $60 in printer ink, $20 in paper, $100 in groceries. You'll allocate $80 to office supplies, $120 to owner's draw. Now your books reflect reality. The business portion is deductible. The personal portion is not. No distortion. Now let's talk about frequency. If you're splitting transactions occasionally, that's fine. If you're splitting transactions constantly, that's a signal. It may mean your systems need tightening because the cleaner your purchasing process is at the register, the cleaner your books are later. Which brings me to a powerful concept. Fix it at the register. If you're buying mixed items regularly, use separate cards. Pay for business items with the business card, personal items with the personal card. Yes, it takes an extra 30 seconds at checkout, but it saves hours in January. The more you push separation upstream, the less cleanup you do downstream. Now let's talk about subscriptions. This is where people get uncomfortable. Streaming services, cloud storage, phone plans, internet, software that your household also uses. The question here is business purpose. Ask yourself, is this ordinary and necessary for my business? If the answer is clearly yes and primarily business use, it may be deductible. If the answer is mixed, then we look at allocation. For example, your cell phone bill. If you use it 60% for business, 40% personal, you may allocate 60% as a business expense, but you need a reasonable basis for that percentage. Not a random number. Maybe you review call logs. Maybe you estimate based on usage patterns. The key word is reasonable. Now here's what not to do. Do not deduct 100% of shared services unless they are exclusively business. If you work from home and use internet for both Netflix and Zoom calls, deducting 100% without support weakens defensibility. But allocating a reasonable percentage based on use strengthens it. Again, methodology over perfection. Now let's talk about receipts you don't remember. This happens constantly. You see a $143 charge at a store and you can't remember what it was for. First, check your email for the receipt. Second, check your purchase history online. Third, look at the context. Was it during a week you were preparing for a client event? Was it during a holiday weekend? Reconstructing context is acceptable. Blind guessing is not. If after reasonable effort you still can't determine the business purpose, err on the side of classifying it as personal. Conservatism protects defensibility. Now I want to introduce you to another circular 230 concept, knowledge of omission. If I know you guessed through a large category of mixed expenses, I have to advise you that guessing is insufficient. But if you tell me, I reviewed each mixed receipt, allocated reasonably, and excluded personal portions, that is supportable. We don't need perfection, we need process. Now let's talk about lifestyle creep. As businesses grow, overlap increases. Home offices, shared vehicles, technology used for both family and business. This is normal. The answer is not to eliminate overlap entirely. The answer is to document allocation logic. For example, if you use your vehicle for both personal and business, keep a mileage log. Not because the IRS expects robotic precision, but because mileage allocation without documentation becomes harder to defend. Same principle with the home office. Measure the space, apply a consistent percentage, keep it documented, reasonable support. Now here's something important. The messy middle becomes dangerous only when it becomes undocumented. If you allocate consistently, document your logic, and separate personal portions clearly, you are operating within the standard. The IRS is not expecting you to live in two separate financial universes. It expects you to report income accurately and deduct expenses appropriately. That's it. Now I want you to hear this clearly. Mixed is manageable. Undocumented is risky. Split it, allocate it, label it correctly, and move on. The goal is not to eliminate every gray area. The goal is to build a repeatable method for handling gray areas because once you have a method, you have control, and control lowers anxiety. Now let's finish this episode by talking about prevention because cleanup is good, but sustainable habits are better. Let's build those next. Now that we've cleaned up the mess, let's talk about preventing the next one because commingling is not a character flaw, it's a systems issue, and systems can be adjusted. The goal is not to become perfect. The goal is to become mostly clean. A business that is mostly clean is easy to reconcile, easy to defend, easy to understand. A business that is constantly chaotic requires emotional energy you don't need to be spending. So let's talk about sustainable habits, not elaborate bookkeeping rituals, simple habits. First, the wallet test. Physically separate your cards. Put your business card in a different slot, or a different color wallet, or a separate card holder. Make it harder to grab the wrong one. The more friction you create at the moment of payment, the less cleanup you'll need later. Second, the monthly scan. This is non negotiable. Once a month, take 15 to 20 minutes and open your business bank and credit card statements and scroll. If you see Starbucks that wasn't a client meeting, Target that wasn't office supplies, a subscription that's personal, reclassify it immediately to owner's draw. Do not wait until January. Memory fades, context disappears. Monthly maintenance prevents annual panic. Third, the to be reimbursed folder. If you should use a personal card for a business expense, don't rely on memory. Create a digital folder or a physical envelope. Drop the receipt in immediately, label it. Then once a month, reimburse yourself. This keeps your personal cash flow accurate and your business books clean. Fourth, fix it at the register. If you're regularly splitting Costco transactions, stop splitting them later. Split them at checkout. 2 swipes, 2 receipts, 2 clean categories. Yes, it feels slightly awkward. No, it's not excessive. It is efficient. And efficiency in the moment reduces hours of reconciliation later. Fifth, simplify where possible. If certain subscriptions are mostly personal, move them off the business card. If certain services are mostly business, keep them exclusively on the business card. The less overlap, the less mental tracking required. Now let's talk mindset. You do not need pristine books to be legitimate. You need consistent effort. Consistency builds credibility. If your records show that personal expenses are consistently categorized as owner's draws, if reimbursements are handled regularly, if business expenses are documented reasonably, your books tell a clean story, and that story is defensible. Now I want to say something important. Do not overcorrect. Some people hear this conversation and swing to the extreme. They panic over every $6 transaction. They build complicated spreadsheets. They obsess over microscopic allocations. That is not necessary. Reasonable support does not require perfectionism. It requires proportionality. Large expenses deserve attention. Recurring mixed categories deserve system adjustments. Small incidental errors that are corrected consistently do not require emotional escalation. And here's the bigger picture. When you maintain separation intentionally, you also gain clarity about your business performance. Your profit is real. Your expenses are real. Your cash flow reflects reality. That clarity makes better decisions possible. Now I want to leave you with this. A business that is mostly clean is a business that sleeps well. A business that is perfectly messy, where everything is mixed and unclear, is a business that avoids looking at its own numbers. And avoidance creates stress. Separation creates calm. So don't aim for flawless. Aim for structure. Aim for monthly review. Aim for consistent classification. That's sustainable. Now let's close this out properly. Well, let's bring this full circle. Commingling is not a moral failure. It's not a business ending mistake. It's not an automatic audit trigger. It's a bookkeeping issue, and bookkeeping issues are solvable. The reason this topic creates so much anxiety is because money is emotional. Your business represents your effort, your risk, your identity. So when personal and business lines blur, it can feel like you've blurred something bigger. But here's the reality. The IRS is not evaluating your identity. It is evaluating your reporting. Did you report your income? Did you deduct only legitimate business expenses? Did you correct personal transactions instead of claiming them? That's the test. And that test is procedural, not emotional. If you accidentally use the wrong card, categorize it properly. If you use personal funds for business, reimburse yourself or record an owner's contribution. If you have mixed receipts, split them. If you've been messy for a while, start now. Cleanup does not require shame. It requires method. Now I want you to remember something important. Accuracy is a practice, not a destination. You are not trying to achieve a mythical state of perfect books. You are building a system that is mostly clean, consistently reviewed, reasonably supported. That's defensible, that's sustainable, and that's enough. If you've been avoiding your bank feed because you're afraid of what you'll see, this is your permission to open it. Not with panic, but with process. Look at it, sort it, reclassify what needs to be reclassified. Move forward. The worst thing you can do with commingling is ignore it for 3 years and then try to reconstruct history from memory. The best thing you can do is address it monthly, calmly, and consistently. And here's the bigger win. When your books are clean, when personal and business are separated intentionally, you get better data. Better data means better decisions. You know your real profit. You know your real margins. You know whether that new software subscription actually makes sense. Bookkeeping is not just about taxes. It's about clarity. And clarity reduces stress. So if this episode helped you realize that your messy books are fixable, if it helped you move from spiraling to structured, share it with another business owner who is currently hiding from their statements. Because messy is normal. Fixable messy is manageable. Ignored messy becomes expensive. And we're here to avoid that last category. Next week, we're going to talk about something that makes a lot of business owners uncomfortable: the math of owing. We're going to break down why owing the IRS money is not automatically a sign that you failed, and in many cases, it's evidence that your business is doing exactly what it's supposed to do: making a profit. We'll talk about cash flow, estimated payments, and how to think about tax bills without fear. Until then, keep your income reported, keep your deductions reasonable, keep your draws labeled correctly. And remember, separating builds clarity, clarity builds confidence, and confidence is what makes your business defensible. I'm Lauren Twitchell, and this is the Zero Fluff Books podcast. We'll talk again soon.